Welcome back to Morning Trade Live. We're going to keep talking some earnings, do a little trading, return to the banks. Joining us, Chuck Lieberman is a co-founder and chief investment officer at Advisors Capital Management. Tom's here in the studio looking at some of the response to these bank earnings. Chuck, welcome back to the show. Do you have a favorite in these banks from this quarter?
Well, the one that I like the best and also did well is Citi. Citi's continuing to improve its situation. They expect to be able to buy back shares. Company is cheap. It's very cheap. Earnings are, the outlook is very positive, especially if M&A and capital markets activities continue to pick up in the second half of the year. So it's very attractive.
What is that general, not to go too macro here, but just for a moment, a lot of the lending centered banks were not a big fan of that inverted yield curve the last couple of years. If the macro does shift the way folks are hoping, Fed starts to be a little bit more accommodative, that generally good for these banks?
Absolutely. The issue and the thing that separates or distinguishes one bank from another is their exposure to retail banking versus their capital markets activities. All the banks with large capital markets activities did well on that side. The retail side is struggling a bit. Net interest margins are being squeezed, and we see that in the most retail-oriented banks like a Wells Fargo. What was interesting about Bank of America is they have a large retail operation, and yet their retail operation did better than expected, and I think that's one of the reasons why we're seeing such a large pop in Bank of America this morning after its earnings. But if you look at the other firms, Goldman Sachs, Morgan Stanley, did better on the capital market side. But the other thing that's also interesting is Bank of America suggested that they expect this quarter to be the weakest on net interest income, and they expect a pickup. So if that's right and net interest picks up for banks as well as capital markets picking up for banks, that suggests that the second half is going to be a lot stronger.
Yeah, that's kind of firing all cylinders, right? If we get that to happen. Because right now it's kind of like you got to choose, don't hate the rates, but if the loan growth gets hit, slows down, then it's not really worth it. So if loan growth picks back up, but we're still kind of lingering at a higher natural rate generally, then you kind of got the sweet spot for some of these companies.
Yeah, but it also depends on what your time horizon is. If your time horizon is very, very short, then you've got to pick and choose. But when I look at these money center banks, I find them all to be very cheap, all to be very well placed, likely to see good growth in earnings, buyback of stock. They've got a lot more capital than they need. So I like all four of the big money center banks.
As you mentioned, the shareholder-friendly activity that a lot of these are engaging in, that's where Citi doesn't quite have the same strength, right? Like they're still going to be limited in terms of what they can buy back at this point. Does that hurt the case for them at all, or how does that factor into the way you see Citi, or is that just kind of a good thing for them at this point?
Well, they actually have excess capital as well, so I do expect them to buy back stock. All of the banks, I think, are being hurt by the Fed wanting more capital at the banks. Basel III still looms out there on the horizon somewhere, and that would restrict bank capital. It would impose a larger capital requirement. But the Fed has indicated that it may not go with the current rules as proposed. They may scale them back, in which case all of the banks have a lot of excess capital. So I'm very positive longer term. I think Basel III is going to be scaled back. It's entirely possible it'll be thrown out completely, but let's assume that doesn't happen. I still think that all of the banks are in great position. They're all financially strong. They're all buying back stock to one degree or another, and the amount varies quarter by quarter. They're all building tangible book, and they're all cheap.
Love it. Chuck, thanks for the analysis. Appreciate the details on the stocks. Very helpful. Good to have you here this morning.
Thanks, Oliver. See you again.
Absolutely. All right. So Chuck does like Citi, a favorite. Tom, but you're going with the stuff that's fresh here today.
Yeah.
On options. now that these events have happened, Bank of America, Morgan Stanley, what's the approach? How do you want to trade these?
Well, you look at Morgan down a little bit post earnings. It was at over 2-year highs going into this report, so the bar was high. Maybe it recovers a little bit. So I looked at a strategy using the option market with implied volatility levels crushed, right? Post the event risk, the earnings are over. But I gave myself some duration on this example trade instead of just maybe buying the stock. It does pay a dividend. I just looked at something out in the October monthly cycle here in Morgan Stanley. So you're giving yourself 94 days till expiration on this one. So you got that 3 months of duration where I'm going to buy a slightly in the money call, the 100 strike call. Then against it to offset some of the costs on that call because there's some extrinsic option premium in those. Sell the 115 strike call. So I'm buying a $15 wide bullish call vertical in Morgan Stanley. You're paying roughly about a $6 debit for it. On that $15 wide bullish call diagonal. If you pay $6, your break even 106 over the next 3 months. That's less than 2.5% above the current share price. So you don't need a monster move in here. And if the stock continues to move higher, like Chuck mentioned, if you think this is going to continue to grind up to the upside, this is a way to take advantage of it in that low volatility environment. And because you're buying that vertical spread, you can, maybe manage it, maybe close a portion of it or all of it ahead of expiration if the stock moves higher, in the next month or 2 months. So it gives you a little bit more flexibility with trade management on this when you're buying the vertical.
Okay, all right. Let's buy the vertical, get a little time, and have some flexibility.
Yeah.
For Morgan Stanley to get some upside on the dip. What about for the rip on Bank of America? Now up more than 3%.
Yeah, I looked at something a little bit more conservative. I mean, you could do the same thing. Maybe you buy a deep in the money call as a stock replacement on Bank of America. I looked at the dividend, about 2.25% dividend yield on Bank of America, and maybe it starts to putter out here a little bit after this the rally that we've seen. Stock's still up 27% so far this year, so it's had a pretty good run to over 2-year highs. So I looked at a cover call strategy where for every 100 shares of stock you buy, selling out of the money call against it. I went pretty tight on this one, but you can adjust that short call because a lot of the out of the money calls to the upside, even if you give yourself duration, don't have a lot of option premium because I think a lot of people put on cover calls. But I looked at for every 100 shares of stock you buy, you sell one of the August 16th monthly options on the 44 strike call. That's 31 days to expiration. You're paying roughly a debit of about $42.10 on this one. It's probably closer to $42.50 at this point because the stock has continued to move higher. But that debit you pay is also going to be your break even. So you're buying the shares at a discount. You're creating yield by selling that upside call, but then you also get yield from the dividend. And this is a type of strategy, if you think it consolidates, maybe it grinds up a little bit more. But as you get closer to expiration over the next month, you're going to have that opportunity to roll or adjust that short call to keep your long stock position to collect that dividend.
All right. Okay. So different approach.
Yeah.
Like that. All right. One that's already moving, paying out that dividend. Yeah. So ride that wave for what it's worth. Bank of America pushing up 4% almost now. Nice move for BAC. All right. Thanks, Tom. Appreciate the trades here.